Hi, it's Dre Griggs with Obsidian Wisdom. Today we'll be discussing 5 important things to remember when you are investing in stocks. So there is a list of things that you often want to make sure that you are keeping track of, that you want to check off before you start investing. Now, many of you are already aware of kind of some of the early stages of things, and that is going to be, hey, I want to make sure I choose a good company to invest in. Sure, of course. But we're going to start even before that. And we want to start with, you want to make sure that you have a financial plan in place. And what I mean by a financial plan in place, it just basically is going to be your strategy, your roadmap of what you expect to accomplish along the way, what is going to be acceptable as far as like losses and gains, when you have a strategy in place of what am I going to do as the market shifts. And you want to make sure that you have a plan that's very well thought out. When it comes to planning, we find that we plan in pretty much every aspect of our life. If you want to take a trip, you come up with a traveling plan. Now, of course, in 2022, it's much easier. So the only traveling plan you do now is I need to know the address so that I can put that into my Google Maps or your iMaps or something like that. But it still means that you have to have some sort of a travel plan in place. When am I going to get gas? How much gas do I need? Do I have to make reservations in the hotel? Am I going to stay there for one day? What time am I going to leave? Different things like that. You want to make sure that you've already have accounted for. And so you want to make sure you have a travel plan. If you wanted to be healthier, you would have a health plan. Whether that is eating or working out, exercising, you'd have a health plan that you put in place. When it comes to your finances, it is no different. If you want to have an investment, then you need to have an investment plan. If you want to get out of debt, then you need to have a debt plan. If your goal is to make sure that you don't have to worry about money ever again, well, then you need to have a never worry about money again plan, which is going to encompass everything. And so that would be making sure that you have like an emergency fund. That would be how much money am I going to invest from my paycheck? How much is going to go towards debt? What is going to be my cost of living? Things like that. You want to make sure that you have a comprehensive plan when it comes to what you're going to do with your money and your finances. And you want to make sure that that is in the forefront of your mind. Number 2 that you want to consider before you start investing is you want to make sure that you have already put together just your overall risk preference, your risk profile. Oftentimes when you meet with a financial planner, they're going to be discussing many different investment types, but it has to make sense to you, or at least if you're working with a fiduciary. So if you're not working with a fiduciary and you're working with someone that's maybe paid a commission, then they're more likely going to be held to what's called a suitability standard. And all suitability means is it just has to make sense, generally speaking, for someone of this age and maybe this income, things like that. But when you are looking for your own unique individual goals, then you want to make sure that you have a unique plan that matches that. Everybody can't deal with the ebbs and flows of the market when you're invested in something that is a high growth potential and it also has a high loss potential. And if you are unable to stomach that, where it keeps you up at night, where you feel uncomfortable and you're very nervous, then you don't even want to go that route because there is going to be that ebbs and flows. It is not always going to be rainbows and skittles where the market is just going up, 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 up. More times than not, yes, historically speaking, the market does tend to go up. But there are some dips and some troughs and some valleys along the way. And you want to make sure that you are not going to be someone who says, you know what, I got into this to make a bunch of money and it's not working for me and I've lost a bunch of money, so I'm just going to sell that stock now. Well, if you sell the stock, you've locked in your losses. So you have to be someone who is comfortable with their decision to where they can work out that long-term plan. As good of a plan as you make, it's not going to work if you don't take your emotional behavior into consideration. And that's something that is being just peeled back as far as the onion is concerned within the financial planning, that is not about just making a plan. It's become more important to understand the person, their goals, their emotions, and how they're going to deal with that, because it's very important to make sure that they're comfortable along the way. We don't want to just drag someone along and keep telling them, just trust me, I'm going to get you there, because a lot of times they don't make it there. And so you want to make sure that you have a plan that considers someone's emotional as well as their financial well-being, and you want to do the same for yourself if you're going to make your own investment plan. Third, you want to make sure that you are diversifying your portfolio. So diversification can be done in a couple of ways. It's usually good to have at least 10 to 15 stocks in your portfolio. Now, if you're not choosing individual stocks, well, then you can go ahead and choose like a mutual fund, because more times than not, they're already going to have 10 to 15 stocks. I've seen some that are even upwards of 20 to 25. So you want to make sure that you're diversified in the number of stocks that you have. The second aspect of diversification is you want to make sure that you are actually choosing stocks that are not all concentrated in the same industry or the same sector. And what that means is if you end up choosing all tech companies, if there is a tech crunch or a tech bubble and a burst, well, then all the tech stocks end up going down. A good example of that would have been if you saw the earnings reports for Uber and you saw the earnings reports for Lyft. Even though they're both ride sharing and tech companies, Uber actually did really well and Lyft did not do very well. But Uber stock still went down because they rode the wave with Lyft. Where if you don't feel comfortable with Lyft and they miss their earnings and some of the upstream battles that they're dealing with, then it would only make sense for you to at least be a little nervous about Uber. That even though they're doing well right now, you feel like it's inevitable that something is going to happen to them because they're in the same industry. So as a result, Uber stocks went down even though they had a good earnings report. But it was based on the fact that Lyft did not have a good earnings report. And so as a result, both stocks went down. So when you're diversifying, you want to make sure that you have at least 10 to 15 stocks, but you also want to make sure that you're not focusing on just one industry. And for some of you, that also means that if you're at a company and they give like employee stock options where they're giving you the stock at a discount from what everyone else would pay, which sounds really good, but you want to make sure that you're being very cautious of that. You may feel like, okay, well, everybody always says invest in what you know. Well, I know this company really well. I work here and I believe in the company, which is great. You obviously should believe in the company that you're working at. But at the same time, do you really know everything about that company? Or do you know a lot about your department and the people that you interact with? Are you actually in the decision-making process? Because there are many companies like the Enrons of old where they are fudging and making numbers look like rainbows, and it's not anywhere near that. And as a result, when the company went under, the employees were the most surprised, at least the ones that weren't cooking the books. But that ends up happening where you may feel the company is doing really well and you're getting it at a discount. So you feel like you're just already taking advantage of a good thing, which I do think you should take advantage of to a degree, but you should not spend all of your investment money in the employee and the company stock. You want to make sure that you are diversifying. And I have clients where it's very difficult, where there are lots of red tape that you got to kind of cut through because the company doesn't want you to be able to invest in different competitors and things like that. So I mean, I get all of that, but they do give you a book that explains to you what you'd have to do to be able to invest in other companies. And I would just say, take that book, sit down and read it over some coffee because it may put you to sleep. And then you'll be able to have the plan because it's still worth the time if you're going to do it yourself. That you don't want to just invest in what's easiest. You want to make sure that you're also investing in what makes sense. And so even if they make something a little more difficult for you, it doesn't mean that that's the only option that you should take advantage of. So I do encourage you to make sure that you at least read the book to find the ways that you can take advantage of this situation. If you have any additional questions, I invite you to check out my free retirement planning that works video training at obsidianwisdom.com/training. And that I give you the entire Wisdometric framework that I use with my clients to help them eradicate financial stress, generate a passive income, and build a prosperous retirement strategy. Fourth, you want to make sure that you're handling all of your finances outside of your investment. I understand that you're asking, hey, what do I need to do? What do I need to think about before I start investing in stocks? But a part of that is the prep work. And inside of that is going to be, well, you want to make sure that you're taking care of your debt. Because if you have debt that's being paid at an interest rate of like 20% and upwards, well, you'd have to make that at a minimum for it to make sense for you to allocate money towards investing instead of you putting that money onto the debt. You also want to make sure that you have an emergency fund in place. You need to have some money that is very liquid, very accessible, where even if the market isn't doing the best, that you don't have to sell shares in a down market because there's no other access you have to money. And you definitely don't want to make it where the only way you can use more money is by putting it back on the credit cards that you just paid off. So if you're going to be planning on investing, if you want to be planning on growing your money, well, then you want to make sure two things, right? One is that you have gotten rid of the debt. And the second thing is you want to make sure you have the emergency fund to make sure that you don't put the debt back on in case of some sort of emergency where something happens that doesn't work against you. And then you want to make sure that you're able to allocate a certain percentage of your income going forward where you're still maintaining that emergency fund. Now, when people ask me, hey, Dre, how much should I have in emergency fund? It honestly depends on your comfort zone, kind of where your plans are, how you feel as far as how easy it is for you to get another job within your skill level, and multiple aspects. So, a lot of times, most people would say 6 months is a good number, and I do think 6 months is a pretty reasonable number. I've seen some where 3 months makes sense. I've seen many where 12 months makes the most sense. But if you're going to get started, 6 months is a good place to get started. That way you can say, you know what? I'm giving myself 6 months where I paid off all of my bills, right? If you don't know, emergency fund means this is the money that I spend each month to maintain my current lifestyle. So if I times 1 month of expenses for my lifestyle by 6, that's how much money I need to have set aside. So as a result, if something happens, I'm able to continue paying my bills at least for the next 6 months without worrying about anything. And during that time, you can figure out whatever it is that you want to do. If that is starting a business, if that is going back to work, if that is having maybe a less stressful but a lower income position, all these options are on the table because you have your emergency funds available. And the fifth and final thing that you want to be considering before you start your investing is you want to make sure that you have a plan as far as how you're going to buy the stocks. And so most often people use what's called dollar cost averaging. And what that means is I'm going to set aside a certain amount of money that I'm going to put in my investment every single month, every single week, or every single quarter. And no matter what's going on, it's going to go within a certain mutual fund or stocks that I have chosen. And as a result, I'm going to have sometimes where I'm buying high, I'm going to have sometimes where I'm buying low, and it's going to average into a pretty good option. That is versus where you take like a lump sum of money and you just put it in the stock, and it may be a great day, it may not have been a great day. The stock may go lower tomorrow, it may go higher tomorrow. We don't really know what's going to happen in the future. But when you do dollar cost averaging, it at least gives you the opportunity to say, I don't know if it's going to be higher or lower in the future, but I'm not going to wait it out because I'm not trying to time it. But I'm also not going to just put all my eggs in this basket. I'm going to go ahead and spread it out over a period of a year and we'll see how we're looking. This gives most of us the ability to be comfortable with our investment where it's being done automatically so we don't have to overthink it and we don't want to be pulling our money out. We're like, oh, I regret it. Oh, it didn't work. Where you already know ahead of time. Sometimes it's going to be advantageous. Sometimes it's going to be a little more expensive than it would be, but it's going to work out in my favor. Now, some of you are going to say, you know what, Dre, I feel really good about my ability to read and interpret the market, and I know the exact moment in time that I should invest all of my money. And to that, I'd say go for it, right? If you feel that good about it, go for it, because that is outside of what the rest of us are able to do. But if you feel that confident in your own abilities, then you should do what's comfortable to you. I'm just letting you know that statistically speaking, it's in most of our best interest to be able to allocate the money over a period of time because we're not spending all the time that's necessary to be able to time it exactly right. Not to say that you can't, but it's just to say so many circumstances change. Where if you knew, oh, well, I know Elon Musk is going to buy like Twitter, and so I will invest, right before he announces it. Well, that's great if you knew that. I don't know how you knew that. But, people in Congress, they do very well for themselves, and I do know it works and that it's possible. But I just know that for you and me, we don't have all of the information to be able to make the best decision in that split moment. And so that's why dollar cost averaging ends up working for most people because we just don't have the information that like our Congress that does oversight and things like that where we just don't know. But if you know, then you know, and then you shouldn't worry about it and you should be okay with it. And then the second part is you want to be thinking about when should I rebalance my portfolios, right? If I have one stock that's gangbusters and it just keeps going up, up, and up, and I have another stock that keeps going down, down, and down, even though I'm putting the same amount of money in the stock every single week, I notice that one is going up and one is going down. That would be the sign where you want to rebalance. What rebalancing means is I would say, okay, my portfolio is going to be like 10% real estate, 30% long-term debt, and maybe like the other 60% is going to be like growth stocks. And so what ends up happening is maybe the growth stocks weren't doing that well, And so even though your intentions were for 60% of your portfolio to be growth stocks, maybe only like 50% of it is, because real estate has just been going like up and up to the point where you're putting the same amount of money in, but it's just growing so much that now 20% of your portfolio is made of real estate. So what you would then do is you would say, okay, I need to sell 10% of my real estate holdings because I only wanted my portfolio to hold 10%. And as a result, you would be selling high. So that would end up locking in your gains because you're saying, you know what, this is going so well, this is going up so much that I want to sell those profits. And now I've locked them in, and then I'm going back to the 10%. And then what you would do with that 10% that you then sold of the real estate is you would then go and buy 10% more in the growth stocks, in your equities. And even though the equities aren't doing that well right now, you had done the research, so you feel very good about your overall decision. And so now you're buying those equities at a lower price, which is like buying low, which also feels really good. So you're selling high and you're buying low, which is what we all want to do when we're choosing stocks. But this helps us to be able to make that, possible, where we're removing the emotional decision making where on the one end, I don't want to really buy any more equity stocks because every time I put money in, it seems like I'm losing it. I put in $1 and I get 70 cents back. Nobody likes that feeling. But if you have the plan in place where you're not looking at it from that perspective, you're looking at it from the perspective of, I'm trying to maintain the 60% of my portfolio is in growth stocks. And so as a result, you just constantly make sure that you maintain that. Not really constantly, but maybe every once a year or once every couple years. I know some people that like to do it once a quarter or maybe, twice a year. You don't really need to do it too frequently. You want to allow the ebbs and the flows of the market, right? You don't want to just be having to make these adjustments all the time and paying these different transaction fees. But if you do it once a year or a couple years or however you want to do your adjustments, where now you're sitting there and you're saying, okay, whether rain or snow, I'm going to be able to say that in my real estate portfolio, if it's at 20%, I'm going to sell 10% of that, and then I'm going to buy more equity stocks. Because more times than not, what we do is the opposite, which is unfortunate, where people are looking like, wow, real estate's going really well, and everybody's like, I want to buy real estate too. And as a result, we end up buying high. We buy the real estate at its highest price. And then when everybody's like, oh my gosh, these equities, these growth stocks are doing so bad, well, I'm going to sell all those because it's giving me a stomach ache. Well, we just locked in our losses and we're selling low. So you want to make sure you have a plan in place that allows you to be able to make the most intelligent decision because you did all the planning ahead of time. So you already have the investment plan. So you already knew exactly what you're going to do when that moment arrived. And so that is going to be the 5 things that you want to consider. And as a bonus, before you consider investing, obviously take advantage of the free money. If you have access through your 401k or your employee plan of some kind to free money where they match a certain amount of money that you put in, go ahead and put the money into the match, because that's at least going to lock in a 100% return, assuming that every percent you put in, they give you a percent match. And if it's not, if it's something a little bit different, then at least you still lock in a very large return that you and I would not just be able to produce on our own. If I told you that you invested $100 and you would get $100 back, well, that's 100% return and you feel great. Well, that's what happens in your employee match. You put in the $100, your company adds $100. That is a $100 gain for your $100 right off the bat. We're not even talking about the fact that the stock itself may actually perform well. We're just talking about the fact that you put in 100 and you have another 100 matching it right away. And so that's just the bonus one, but those are the 5 things that you want to make sure that you consider before you start investing in the stock market. And these are the things that I always talk and discuss with my clients. You always want to make sure you have a good plan in place. Until next time, Wisdomites, remember, wisdom is asking the right questions to allow yourself to get the right answers. Keep asking those questions and you will keep getting those answers. Continue blessings.